It was another strong day for the bulls with the S&P 500 closing up 1.36% today. We saw that 88% of the companies in the S&P 500 closed in the green, and we now have 53% of the stocks in the market closing back above their 200-day moving average. So we've had some very nice stabilization within the markets here recently, and in particular with today being a couple of days in front of the Thanksgiving holiday. That's from a seasonality perspective also a pretty strong time of year. So we're going to walk through all of that, see what it means for our various postures in tonight's video, and then we'll get into our trade application example where I ask the question, have you ever wanted to own a professional sports team? And if the answer to that is yes, then maybe you will enjoy tonight's trade idea. And then at the end of tonight's video, I also want to spend a little bit of time for those of you who are inquiring about our premium service at Market Scholars and what you can expect if you become one of our premium members. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 22nd, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list. Remember, we'll be doing our Black Friday sale here later this week, so if you want to be notified about that discount, make sure you're on our email list ahead of time. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And it was another strong day for the bulls. As you can see, we have a sea of green here, a wonderful view if you're more bullish on the markets with most of these sectors kind of pulling their weight here today, right? We've had some days back and forth where maybe some of the sectors were kind of sitting out the rally, but today kind of felt like it was just everybody advance. And remember, we are now part of that Thanksgiving week where we do have a bit more bullishness typically that goes into that. I had mentioned that Stock Traders Almanac when I was with you guys last time on Thursday, and one of the things that they track is activity around holidays, and you do tend to find that there is bullishness right around that Thanksgiving holiday. And so we're kind of getting the good graces and benefit perhaps of that seasonality. Keep in mind that volumes are quite low, as you can probably imagine. A lot of folks probably taking the whole week off to spend time with friends and family and what have you. And a reminder of later this week as well, markets are closed here in the United States on Thursday. So our classes at Market Scholars will not be held, and we won't be doing the Market Outlook video that night since there won't be anything to review since the markets won't have been open. So keep that in the back of your mind. I know we have an international audience as well, and sometimes that kind of comes as a surprise that we have these different holidays, and one of them that we have here in the U.S., of course, is a rare Thursday holiday with Thanksgiving, and then Friday there will be, I think it's a half a day of trading. It's a reduced hours day. I don't teach classes that day, so I'm off anyway, but David will be taking that day off as far as I understand as well. He might come back and do the Market Outlook video. You'll have to see with him on that, but I know his normal class that he would be holding otherwise will not be held. So be aware we've got our holiday schedules upon us, and we hope, of course, that all of you enjoy your time with friends and family around Thanksgiving and other holidays as well. But anyway, point being, a lot of bullish activity tends to happen around Thanksgiving, and we are kind of following suit here once again, it appears, on lower volume. Let's get into some of the details here now. As I look at some of the brighter patches out there, I would say that energy came roaring back pretty nicely. And remember, that was a little bit of a concern here within the past week. There was a day or two where it was kind of touch and go there with energy. And so that's one that I want to keep on my radar because energy's been so strong for so long that there's always that possibility that it needs to roll over and money needs to flow somewhere else. Then again, if you wanted to make a fundamental case for the market and for the various sectors, you could get away with saying that the energy stocks deserve to be the strongest because that's where the profits are right now. A lot of the other sectors are struggling to find profits. And so anyway, it was nice to see a pretty strong bounce back here. Chevron Chevron, Exxon, both up over 2.5%, Occidental up over 4.5%, and so on and so forth. You will see that the biggest mover here today was Best Buy. It was actually up 12.78%. That was the best performer in the S&P 500. Happens to be a stock we own in our dividend growth investing portfolio. On the flip side of that, we do also own Medtronic, which was down 5% here today. So a little bit offsetting there, I suppose. But all in all, our dividend growth investing portfolio has been doing remarkably well. We are well back into the green here this year, which I know not a lot of people can claim. Remember that today happens to be the 1-year anniversary of the NASDAQ topping out. It was last year on November 22nd. And here we are 1 year later, and the NASDAQ is still essentially down about 30%. Now, some of the other indices aren't down nearly as much, but it does go to show you that in the past year, this has been more of a kind of stock pickers type of a market. If you've been focused on kind of old school blue chip types of companies, especially dividend growth stocks, you've done reasonably well. If you've been focusing on tech stocks and other kind of more exciting areas of the market, you have likely suffered. In fact, I was mentioning here a little bit earlier on Twitter and in my class today that I was very pleased and wanted to express my gratitude here this Thanksgiving week for my own dividend growth investing portfolio back to all-time highs. And I would not have guessed that would have been the case just a month and a half ago. And I said that it wasn't as a result of a whole bunch of fancy trading or hedges or exotic instruments or anything like that. This particular portfolio, which is my biggest retirement account and represents more than half of my investable net worth, it's a large portfolio for me and the most important one. All I own in it is 38 holdings, every single one of them paying dividends. In fact, 30 out of those 38 are dividend aristocrats. And as I mentioned to my students earlier today, one of the keys behind that, of course, asset selection is important, but a lot of people conveniently forget that it's easier to get back to all-time highs if you don't lose as much to begin with. I know that probably sounds pretty obvious, but this red dot right here is basically my max drawdown, which took place about a month and a half ago, whenever that pullback was happening there in October. And I've come all the way back and tacked on additional money even since I took the screenshot, because today was such a strong day. This was actually as of yesterday's close, I believe. But the point being, I am now back to all-time highs without doing anything exotic whatsoever. And so I can't claim that this will always be the case in the future. Obviously, I would have no way to guarantee that. But what I can say is that it has mattered over the last year where you have had your assets. For many years, the FANG stocks and everything tech-oriented was ruling the day. And so if you were not having most of your portfolio in those types of companies, you were probably lagging the market, as I'm sure I was at that time. But it's when the tide goes out, you start to find who is swimming naked, as the old saying goes from Warren Buffett. And there were a lot of people, apparently a lot of companies, swimming naked, like the Carvanas of the world and the Pelotons and the Palantirs. And we had so many of these companies that came to the market with these exciting ideas that lured investors into those ideas. And now they're staring at massive losses. Many of those companies are still down 70, 80, 90%. Whereas an old school portfolio of nothing but dividend paying companies is hanging in there just fine, in fact, doing quite well. Now, part of the story behind this is, of course, the dividends themselves have been reinvested along the way and have allowed that to benefit me on this up move as well. And I don't want this to come off as though I'm saying the coast is clear, because I personally don't think that's the case. I personally think that we have tougher times in front of us, but it is a reminder for those of you that enjoy the prospects of long-term investing, as I do as a dividend growth investor, that there's a reason why we take such care in the selection of our securities to begin with, because we know that as long-term investors, bear markets are a rule, they're not an exception to the rule. And you have to ask yourself, which companies do you want to go into battle with when we do go into that war zone of those bearish market conditions? And I don't want to go into battle with the Carvanas of the world. I wouldn't mind going into battle with the Johnson & Johnsons and Microsofts and Procter & Gamble's of the world, right? So anyway, some of you, like myself, probably have a lot to be thankful for this Thanksgiving if you are also a dividend growth investor. And remember, I teach dividend growth investing every single Tuesday morning. This morning, we concentrated on the financial sector. That recording is now available for those of you that are premium members. And if you've never really been taught investing or dividend growth concepts before, and you wanted to test your mettle in that regard, I'd be more than happy to throw my hat in the ring to try to help teach you. Obviously, I can't guarantee anything. I am an educator. I'm not your financial advisor, but a lot of my students have found success over the years. And with our Black Friday sale coming up here soon enough, we do hope that you will consider joining us because, of course, we teach 8 different trading rooms every single week, just one of them being dividend growth investing, and of course a lot of other stuff that you're going to do with David and myself in other corners of the market. But my own personal passion is dividend growth investing, despite what some of you may think, because a lot of you just watch my free videos here on YouTube where I hope to support David in more of an active trading sense with this market outlook video. But that's not actually my true passion in life. My passion is actually dividend growth investing, and I would love to be able to teach you or other loved ones that might have an interest in that. So keep that in the back of your mind as we head towards the Black Friday sale here a little bit later. All right. Anyway, not a whole lot to report from consistent red out there. Again, this was one of those days where it was pretty much an onslaught of bullishness. I did notice, however, that a couple of my bearish trades here more recently in this video were still in the red today, including the one on Thursday. Some of you that watched that video know that I did that long put spread on Datadog, and Datadog has been down every single day since then, 3 days in a row, and that trade has worked out beautifully since then. And I also noticed Airbnb was down here today as well, and that was another recent trade video that I did for these YouTube videos. So thankfully, we've had a market that has largely been stubborn to the upside, but fortunately, a lot of the bearish software-related trades that I've mentioned to you guys in this video have actually been going down. That's the best of both worlds, because remember, I had already done the Zscaler trade, I had already done the CrowdStrike trade, and then, as I mentioned just a moment ago, Airbnb and Datadog. So it is very interesting how a lot of the tech-oriented charts out there still look ugly despite the market itself advancing on the backs of a lot of these more blue chip oriented areas. So a great day here for the bulls. Even some of the tech stocks kind of getting into the fun here, with Nvidia up 4.7% and Apple up 1.7%. Agilent had a great day, letter A in the alphabet, the very first one right there. They were up 8% off of their earnings announcement today. Alphabet, speaking of Alphabet, the company, Google, was up 1.5% today as well. So a strong day across the board. A joyous day if you have long assets out there benefiting from these moves. Let's go ahead and take a look at some specific numbers behind this now. And for that, as you guys know, I tend to pull up this Market Watch Visualize area on the Thinkorswim Paper Money platform, and you'll notice in the visualization area I've got the index watch pulled up with the S&P 500 as my watch list. And of those 500 stocks that make up the S&P 500, 443 of them were up here today. So a very strong showing. That's good for about 88% on that hit rate there. So 88% of the stocks in the S&P 500 closed in the green today. That is a very bullish sign. Again, you do have to remind yourself today did not have a lot of volume. So there will always be that question mark where if there were all market participants in this holiday shortened week, would it have been as strong as it was today? We'll never know. But we've also got to acknowledge the truth of the situation. If you had stocks in your portfolio portfolio today, you likely benefited from that upward move, whether it was deserved or not. So it's not like they're going to ask you down at the bank, hey, did you get that from an undeserved day or a deserved day? They don't care at the bank. If you're cashing the checks, all they care about is that they are legit. And today was a legit day for the bulls. Let's go ahead and now take a look at some of our charts. And remember, whenever we have more than a 1% move, either up or down in the market, I like to kind of kick our charts off with this chart 6D right here. Remember, as part of the 3-year premium package that David and I offer our market scholars, you get access to the 50-plus different customized charts that we've built over the years as well, including this one right here. And I like to bring this up on either a big up or a big down day, just because I want to give you a different sense of volatility and to kind of see where that volatility is taking place. And as you can see, this green bar kind of in the middle and off to the right here has stretched up and over this blue horizontal line here, which, as you can see from the label, represents a 1% move higher in this case. There's also another blue line below the black line, which would be a minus 1% move. So today was a pretty strong day. In fact, this was our best day in the market since that really crazy day a couple of weeks ago when I was with you on that Thursday, which was one of the best days we had had in the last couple of years. So that was a very dramatic candle that you don't see very regularly there. So if you took that out of the equation, this is actually the best day here since going all the way back to the end of October. So the other thing that kind of catches my eye when looking at this is when you're looking at the extended green bars up and over the blue line, or the red bars stretching down and below the blue line on the underside, to my eye, it seems like we've had more of these green bars to the upside recently, the larger green bars, than the red bars below it. And again, that is a sign of more bullishness in the market, a recognition that the markets have stabilized nicely since putting in this low back here on October 13th with that really nice bullish engulfing candle, and has followed through very nicely to the upside along the way as well. Obviously, it doesn't go up every single day. We had a 4-day sell-off here that started to, getting us to question whether it was sustainable or not, and we still have questions about that. In fact, tomorrow, one of the things that will hit the tape is that we will hear the Fed minutes from the last meeting. So it won't be another interest rate decision tomorrow, but we'll get to learn what all the different Fed governors and speakers and Jerome Powell and others are truly thinking as they release their minutes from that meeting. And sometimes that has the ability to jolt the market. So we shall see if that has that opportunity tomorrow or not. But just on a purely organic perspective, this is the type of behavior you want to see if you want to see the markets rebound. Now, history suggests that when we go through these bigger bearish types of moments in time, like 2022 has largely been, especially if you're in the tech-oriented areas and not in the big blue-chip dividend-paying companies. But this has been a difficult year for a lot of investors and traders out there. And what history has suggested is that those types of moments in time usually are not very fleeting rapidly. In other words, usually we have to earn our keep with a longer period of time than just less than a year, right? Even with the NASDAQ, it has not taken out its low from here a month ago. And with today being the 1-year anniversary of its high, that basically means from high to low, it was not even one full year. Let alone the S&P 500, which effectively put in its all-time high right here at the beginning of this calendar year. It happened to be January 4th, the second trading day this year was when the S&P 500 put in its high. But either way, if you're looking at the NASDAQ or the S&P 500, we've really been at these difficult, more bearish conditions for less than a year at this point. Now, obviously, the market's going to do whatever it needs to do. There is no official rule book to the market the way that there might be in the NFL. Congratulations to you 49ers fans last night. That was a heck of a win over the Cardinals. And I'm saying that as a Rams fan, so I'm coming to you with a with a branch as a dove, right? In peace, in other words. So my Rams are pretty much out of it. Let's put it that way. But in football, you have actual rules, right? And you have to abide by those rules. In trading and investing, there are no rules. Anything goes. There can be manipulation to the upside in the case of things like GameStop a couple of years ago. There can be manipulation to the downside, as we're seeing with a lot of the cryptocurrency shenanigans that's been going on here more recently as well. There's no real rule book out there. Obviously, there are things that are illegal that you shouldn't do unless you want to spend time behind bars, but there's not an actual rule book. So just because something has typically happened in the past doesn't guarantee that that will always be the case in the future. So we have to acknowledge that as well. But it is true that in general, this bearish environment that we found ourselves in 2022 has not lasted all that long. And quite frankly, we never really had a major capitulation, at least from my perspective. There's probably a number of ways that you can measure that. We certainly had oversold conditions with all of those oversold cluster signals and what have you, but it didn't have the true feel of actual capitulation like we experienced in 2009 and 2008 and also back during the dot-com bubble, right? So whether we are going to get that in the future or not is anybody's guess, but it's something that certainly haunts the back of my mind, understanding that as somebody who has my long-term assets on the long side of the market, I basically am prepping myself for more pain ahead before we're off to La La Land. But, if that's not the case, I'll be happy to admit that as well. Obviously, thrilled in terms of my long-term assets getting back on track sooner rather than later. And so maybe this is it. Maybe this is the start of something big to the upside. I have my doubts, but right now what we can say factually is that this has been a pretty strong and robust rally. It's a little bit skewed up here, but you get the general gist where we have a low, we have a higher low, we have a high, we have another higher high, we have another higher high. And we're working on yet another one here if we can get up and through that here in the near term. So we shall see. But if there has been volatility lately, it's been volatility to the upside. Notice that the traditional VIX down below has been rolling over. We find ourselves at 21 on the VIX. Remember, it wasn't so long ago we were at above 30 on the VIX. If I were to pull up the actual VIX now to look at the candle chart on it, you can see that the VIX was here above 30 just as recently as the middle of October. And now all of a sudden, we are threatening the possibility of breaking 20 to the downside. So that is also telling you that some of the fear is leaving the station. Now, whether that is rational or not, we all have to kind of debate that. I still think that this is a market where you better be safe rather than sorry, but others will see it another way. And it is true that for the most part in the past, dips have been meant to be bought. And I still believe that from a long-term perspective. It's just the question that I wonder about is whether we'll get an even greater dip to buy next year. And therefore, if you do believe that earnestly, then keeping some dry powder for that moment in time could be useful. But anyway, what this is suggesting is that a lot of professionals are not necessarily piling into the options market to protect their portfolios. So they're feeling a little bit more comfortable and confident about this market's prospects to rally into year end, which oftentimes happens from a seasonality perspective, right? November, December, January typically is the strongest 3 months of the year for the market. Whether that happens this year or not, anybody's guess. But historically, that tends to be the case. So that might be playing a little bit of a role here with this VIX rolling over at the moment as well. So anyway, a very strong day there for the market, another down day there for the VIX. Let's go ahead and do our 4-grid now, kind of get a lay of the land after today's nice move. And this is chart 4B for those of you that are premium members following along at home. One thing that catches my eye right out of the gate is that all 4 of these charts effectively closed at their highs of the day. In fact, it was a little bit aggravating for me today. I actually ended up having a different trade idea than my original thought. I was trying to get filled on a different trade idea within the last half of an hour of trading, as I typically do, because remember, one of the benefits we provide our premium members is we do these market outlook trades before the market closes and then send out that information via Telegram, so that way you guys can all consider that that are premium members before the people that watch the free video get that information, just to give that little perk for those folks, right? That's our business model. We don't make money off of doing these free videos on YouTube. We do make money off of selling our premium subscriptions. And so we want to give those people the most benefit as possible. So anyway, my typical approach is to kind of look for my trade ideas maybe within that last hour of trading, and then start putting those trades on with about a half an hour to go. Well, today was one of those days where I put my trade on relatively early and I could not get filled. And the reason for that is the market just kept on going higher and higher and higher without any pullback in that last half of an hour. So if I wanted to do a bullish trade as I did today, then that was not good for me. Now I could have chased it, but of course I'm somebody who would prefer for the market to come back to me if at all possible. And sometimes that doesn't always work. So anyway, I did opt for a different trade idea, which I'll review with you later in tonight's video. But that was certainly one thing that not only do I recognize right now with my eyes, with us closing at the highs of those, what I refer to as empty candles right there, basically meaning that we started at one point and we closed at the high of the day. But I just also noticed it anecdotally because I was trying to get filled on a different trade and I couldn't get filled because the trade just ran away from me in the final half an hour. And I kind of get the sense now looking at these indices that was probably happening with a lot of stocks out there. So it was a very strong ending to what was already a pretty strong day here today. Again, with the understanding that volume wasn't particularly strong, but those that were around trading wanted to push this market higher. So the S&P 500 was up 1.36% today. The NASDAQ tied it up exactly 1.36% as well. The Dow Jones was down a little bit less than that at 1.18% to the upside, so it lagged a little bit today. And then the Russell 2000 was today's true laggard, just barely underperforming the Dow. The Russell 2000 was up 1.16%, so just a hair below the 1.18% of the Dow. So you can call this basically the S&P 500 and the NASDAQ tied as the leaders, and you can pretty much say that the Dow Jones and the Russell 2000 tied as the laggards here on a one-day basis today. Now, on an intermediate basis, as I've been telling you guys since we bottomed, which has been over a month at this point, the story's different. There, the Dow Jones is our leader. It was our leader back here when we had this big bullish engulfing candle, and it's remained our leader this entire time through. And notice how the Dow Jones Industrial Average chart in the upper right-hand corner here looks different than the rest. It should catch your eye, but if it doesn't, I'll point it out for you. Notice our high label is now above today's candle, meaning that on this 3-month chart, the Dow Jones Industrial Average literally today closed at its 3-month highs. Notice with the S&P 500, we're still well below those highs from about 3 months ago. Same thing with the NASDAQ, even worse. It's still well below its highs from 3 months ago. And the Russell 2000 still has a long ways to go from its highs from 3 months ago as well. So the Dow is standing out here as being the one that's making the most legitimate move. And that ties into what I was mentioning to you earlier about my own experience as a dividend growth investor of these 4 major indices. The one that is most closely aligned with the idea of buying blue chip dividend paying companies is the Dow Jones Industrial Average. So, it's not just a fluke. It's like, if you have indices that are doing reasonably well, they probably have a pretty good helping of dividend stocks in them. In fact, another thing that I might point out here real quick, let me go to a different chart because we have a label for this. But one thing that I found to be interesting is that Noble, this is ticker symbol NOBL, this is an ETF that tracks the dividend aristocrats. And again, remember what I'd mentioned to you before, how many aristocrats I personally own in my own portfolios. And that's just one of them, by the way. I actually own a lot more aristocrats in some of my other portfolios. But this will at least give you a sense as to why us dividend growth investors have a big smile on our face this Thanksgiving. Notice that NOBL is right now just 5.8% away from its yearly high. Now that's still off of its yearly high, but still it's not that far off of it. Now compare that number to something like the NASDAQ as we pull up the Qs from an ETF perspective to get a sense of what's happening with the NASDAQ 100. Notice that it is still off 29% from its highs. Those two numbers are so night and day that it is a reminder that this has been a stock picker's market. This is not a market where all stocks are traveling together highly correlated. This is a market where if you are in the right places with the big blue chip dividend paying types of companies, you are weathering this storm tremendously better than somebody who is focusing on all those software stocks that's just getting punched in the gut, day after day after day out there. So it has been very obvious to me, not only anecdotally with my own accounts, but just looking at something like that and acknowledging that the dividend aristocrats are literally only 6% away from their all-time highs, and the NASDAQ is still down 30% from where it was a year ago. Now, whether that holds true moving forward is anybody's guess. What we know factually is that is true looking backwards, and that has been a stalwart area for your portfolios if you've got some exposure there. And you can really kind of say the same thing about the Dow. The Dow's not doing quite as well on that count as the dividend aristocrats specifically, but it's not too far away. In fact, I should have looked at that while I was over there. Sorry. Let me flip back real quick and look at DIA. And you can see here that the Dow is only about 7.7% off of its high over the past year. Again, comparing that to Noble, which is down 5.8% from its high. So dividend aristocrats doing a little bit better than the Dow, but they're both kind of in that same general neighborhood right now. And they are doing tremendously better than stuff that has the more exciting tech exposure like the NASDAQ. So that's what really stands out to me today, is that the Dow continues to be our intermediate term leader in this market, and we can now celebrate new multi-month highs on the Dow, which was able to get up to those new levels faster than the other three indices, just as I had mentioned at one point along the way. Of course, I can't remember what video it was, but I basically just said that, hey, since the Dow has this much leadership already, if you expect the markets to continue to be bullish into year end, then you're basically suggesting that the Dow is likely to be the first one that gets back towards those highs again. That's exactly what has played out here. So we shall see if it continues or not, but what we do know at this moment factually is that the Dow has an intermediate reading of about 94 or 95, and we look at these green labels for the S&P 500 at 88, the NASDAQ at 74, and the Russell 2000 at 78, and none of them are particularly close to the Dow Jones. And so it's been really remarkable to watch the blue chips really take it to the scrappier upstarts here more recently. So the Dow remains our leader. I would say that the NASDAQ is probably still our laggard, again, with their intermediate reading at 74. Notice they still have that light pink background color on the chart because that green line fell out of the upper reversal zone right there. Same thing happened there with the Russell 2000. However, both of them are so close to that upper reversal zone that it really wouldn't take much to punch it back up into the upper reversal zone. And if that would occur, then that background color will change back to dark green once again. So, if we can get a nice follow-through day tomorrow to the upside, then it wouldn't be entirely surprising to see those postures click back into bullish once again. But for the S&P 500 and the Dow, they remain in that strongly bullish territory. And all four of these charts do have those green moving averages telling us that price is above a rising moving average. All right, let's go ahead and step aside here, pop on over to the internet briefly. I always like to say thank you to those of you that help support these presentations. Let's see, what was the day that I did the video last? Was it this day? Yeah, I think it was the 17th. I know we're up and over 100. I checked it earlier today, which is why we're doing a full-length video right now. But let's get the specific number. Specific number is 117 likes there. So thank you to you 117. As I mentioned before, we don't get paid to do these videos. We do them for a variety of reasons. One of them to help educate you, and another reason to get our word out about our company, right? With the hopes that some of you will take your education to the next level by signing up for our premium package. But we don't get paid to do these videos. And therefore, we have to ask ourselves regularly, every single day, whether it's actually worth the 3 hours of our time to do these videos. And some of you will maybe debate whether you think it's worth our time or not. Depends upon your mindset and your mood, perhaps, at that time. But I can say in this case, with that Datadog trade that I did for you guys on that last video with the trade application example, as I mentioned before, that's worked out very nicely for us. So at just a bare bones minimum, if you enjoy seeing my trade presentations and what I'm looking at during the day, and you found some success with some of those, and by the way, we hit another big winner today with our Northwest Natural trade, NWN. Some of you will remember that I did that bullish swing trade in this presentation a couple of weeks back, and that hit our max gain here today as well. So not only are most of our bearish trades doing pretty well, not all of them, there's a handful like Goldman that hasn't worked out very well, but like I mentioned before, some of those software stocks, Zscaler and CrowdStrike and Airbnb and Datadog, they've all done really well in terms of continuing to be bearish in what has otherwise been a bullish market environment. Remember, that's not easy because most of the time, if the market is going to go up, your bearish trade should be struggling. But we really haven't experienced that with my trades that I've been delivering to you for free on this video. So if you appreciate the effort that I put into going out and hunting down a trade idea for you and you want that to continue, I ask one simple thing out of you. Just click like for me on Twitter. As long as we're up and over 100 likes, more than happy to do a full-length video. If we're under 100 likes, then I have to really, second guess and question whether it's worth my time to do these videos or not. So I'll let you guys decide collectively there. But I do appreciate all of you who did that for me last time around. Okay, and let's also maybe pull up our, let's go over here to our sector selector now as well and have a little chat about where things stand from a sector rotation perspective. We didn't have a lot of week-over-week changes. Now remember, this gets updated on Fridays. And like I mentioned to my students on Monday when the energy stocks were down, in real time, energy was back into the middle of the group here. Now they bounced back today, so they might be kind of trying to make a last-minute push back towards the number one. But just a reminder that this static particular graphic right here is as of Friday. And I do this every Friday, so that way we can compare them week over week to see any rotations that may or may not be taking place along the way. But you'll notice that we hardly had any change whatsoever from the prior Friday. The only change that we saw was in the exact middle of the graphic, where we saw a slight improvement in healthcare and a slight detraction there out of materials companies. Another thing that I wanted to bring up real quick about this, now that it's on my mind, is some of you might be surprised to see consumer discretionary up here in the number 3 position, because you've probably been staring at Amazon and Tesla and wondering how in the world can consumer discretionary be scoring so favorably under your ranking methodology. And the reason is I use an equal weighted approach to these sectors. I don't use a market cap weighted approach. And I actually tweeted about this. I think it might have been yesterday. So let me see if I can find that tweet here for you and kind of help explain that through a visual a little bit better as well. Yeah, here it was. I said if you're in the habit of only looking at the market cap weighted sector ETFs, you might not actually be getting the full story of what's happening with the typical stock in that sector. For instance, XLY, which is the typical proxy that most people will use for the consumer discretionary space, it looks terrible right now due to Tesla and Amazon. Because remember, XLY, like the S&P 500, is market cap weighted. So it means that a stock that's worth close to, $500 billion or whatever, like these two are, they're going to have way more sway on the pricing of XLY than some of the small clothing retailers and things like that that are out there. But the truth of the matter is, RCD looks strong. And RCD, if I were to kind of zoom in here, as you can see, this EW stands for equal weight. So this is market cap weight on the left with XLY. RCD on the right is equal weight, basically saying that it's going to give each discretionary stock in the S&P 500 the same weighting. And look at the tremendous difference between these two. Now, this was taken yesterday, so these numbers might be slightly different, but you'll still get the point. First of all, just look at the charts and look at how much better the RCD looks than XLY. XLY looks like it's rolling over underneath a falling 30-day moving average, whereas RCD, which also tracks consumer discretionary stocks, is up here closer to 3-month highs than to 3-month lows. Notice that we have the green moving average on RCD, we have the red moving average on XLY. But then just look at the numbers themselves. This is showing things on a percentage basis, and in the last 3 months of this chart, XLY is down 15%, whereas RCD is actually up. Now, it's not up by much, but hey, it's a heck of a lot better than down 15%. And what that's telling us is that a lot of the mid-cap and smaller cap types of consumer discretionary companies out there like Tractor Supply and Restaurant Brands International and TJX, those companies are doing very well right now price-wise, even though so many people have their eye off the ball and are only looking at Amazon and Tesla. So that's a good educational reminder there that there sometimes is more than meets the eye, right? So keep that in the back of your mind as well as you move forward with your studies of the market. All right, let's get back on track with some more analysis now, looking at our 12 grids, and this is chart 5A for those of you following along at home. A reminder that the background colors will be either green or pink. When the charts are green, it means they have a bullish posture. When the charts are pink, it's a bearish posture. And it has been the case more times than not in 2022. You can see right here in the lower right-hand corner, I like to focus my efforts on those areas because it's really been dictating what has happened with the market itself. And once again, that kind of held true today. Notice that both the US dollar and the 10-year Treasury yield were down today, right? Red candles on both of those, and that's a big reason why stocks were up, right? There's kind of like that Rorschach test there. More times than not, obviously there are exceptions to the rule, but more times than not in 2022, if the dollar and yields have been down, stock prices have been up. The problem is for much of this year, it's been the opposite up until recently. Earlier this year, interest rates just kept on going up and up and up and up, and the dollar kept on going up and up and up and up, and stock prices kept going down and down and down and down. So they have considerable sway over the market right now, and if they are in more bearish territory, as they have been, that is kind of giving the stock market participants a get-out-of-jail-free card, and they've been taking it for all it's been worth here in the last month and a half to the upside for stocks. So U.S. dollar down again today. It remains with a strongly bearish intermediate posture according to the market forecast and is still trading below its falling 30-day moving average. Notice that TNX, which tracks the 10-year Treasury yield, was also down today. It also has a strongly bearish intermediate posture and is below its falling 30-day moving average. The dollar still looks worse than the 10-year Treasury yield, but it's not like the 10-year Treasury yield looks good or strong, right? It does not. It looks toppy up here. And whether it continues to be toppy remains to be seen. But what the truth of the matter is this chart has been a little bit stressed compared to the easy pathway it had higher here earlier in the fall, where it just felt like nearly every day or every week, interest rates were going up, 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 and away. That has not been the case for the last couple of months. We've now seen more stress, more pressure, more selling within those. And so naturally, when the 10-year Treasury is down, bonds are typically up, right? There's that inverse relationship between prices and yields. And that did hold true once again today. Notice that TLT was up 1.4%. It has a strongly bullish posture. It is now above its rising 30-day moving average. Remember when I was last with you on Thursday, that was not the case. We were talking about how foreign bonds and high yield bonds were already there, but TLT still had its yellow moving average at that time. Here we are 2 or 3 days later, and we now can say that they've kind of joined the party there as well. So there has been stabilization in government bonds. There's been stabilization in foreign bonds. There's been stabilization in high yield bonds as well. So for a lot of people, this was getting a little bit too uncomfortable to the downside on TLT earlier in the year. And now things have kind of started to de-stress a little bit. We're all kind of breathing a collective sigh of relief here. And things have kind of started to calm down, I think, within most of the financial markets out there. One area where there's probably been less calm activity is Bitcoin. Bitcoin was up a touch today, but as you can see, is still hovering right around 16,000. Now, when I was with you last week, it was closer to 17,000, so things certainly haven't gotten better for Bitcoin. Things have continued to be quite controversial in the cryptocurrency arena, especially ever since this whole scandal with Sam Bankman-Fried and FTX broke. It just seems like it has basically thrown the reputation of everything crypto-related into the toilet, and even if Bitcoin is the strongest cryptocurrency out there, its reputation is being damaged right now. So those of you that are bearish on Bitcoin, you are still in your moment to shine right now. This has got a lot of work to do to get us back to looking like a chart that looks like, the S&P 500 or, some of these other risk-on types of assets. Bitcoin is not participating the same way that stocks are at this moment in time. So that's a little bit more concerning there. Foreign stocks did pretty well today. We saw that the developed foreign stocks outperformed the U.S. markets. However, the emerging foreign stocks did not. They were only up 0.24%. So for whatever reason, there was a lack of activity there with the emerging market stocks compared to the developed foreign stocks like the traditional European markets and what have you. And so let's go ahead and do our next 12 grid now and take a look at the sectors here in the United States. Now, a reminder that this is the market cap weighted, more popular sector ETFs that are out there, like the XLYs of the world. For those of you that are premium members, remember, if you were looking for the equal weighted 12 grid, you can come in here and go to chart 1G, and that will be the equal weighted sectors right there. But this one is 5C that we're looking at here in tonight's video. And as you can see, there are only two pink charts on the board. That's communications and that's discretionary. Now, of those two, communications is looking maybe a little bit healthier. Notice that communications is above its rising moving average right now, despite having the weekly bearish posture. So remember that weekly bearish posture can be flipped to bullish much more quickly than a strongly bearish posture. So it's kind of testing those levels right now. But as it's kind of trying to bounce up and off of that moving average, it looks a little bit better than what we're seeing with the discretionary. Here you can see the moving average color is still yellow. In fact, it was just red yesterday, and so it's not green like we see up here, and therefore it's kind of giving us the sense that it's playing a little bit of a tug of war on either side of that moving average from a price perspective. It's not a great sign there. Of course, as mentioned before, Tesla and Amazon are two of the big reasons behind that. Tesla itself was up today, but it didn't even beat the S&P 500. Remember, when we usually have a big risk-on type of a day like today, Tesla is going to destroy the S&P 500 to the upside. So that's even saying something that even today, when the markets were wildly bullish, Tesla still underperformed the S&P 500 itself. It was up, but not up as much as the S&P 500, and it's had regular oversold cluster signals here as well. We actually did a bearish trade on Tesla a couple of weeks back in my factor-based swing trading class. That went to max gain nicely for us. But for those of you that have continued to be short on Tesla, that has continued to be a wise decision for the most part. Now, obviously, you are getting a lot of these green dots showing up here, and so you'd have to expect there will be some sort of a reversion to the mean type of a move. It's just a matter of whether that will be a trend-changing type of a move, and right now it's not looking so good. Elon Musk obviously has his hands full with trying to run Twitter right now, and is probably not putting his full amount of energy behind Tesla, and perhaps that stock is suffering as a result. Amazon is the other big player in XLY, and as you can see, it is also in this really kind of ugly chart pattern here, clearly strongly bearish posture below that falling moving average. So that's why XLY looks as it does, even though stocks like Tractor Supply are in significant uptrends. Stocks like Restaurant Brands International, significant uptrend. Stocks like TJX in a significant uptrend. So there are plenty of discretionary stocks that are rocking it to the upside. The problem is the two most important ones, Tesla and Amazon, are the exact opposite, and that is weighing upon XLY itself. In terms of the other charts, as mentioned before, I think it's worth pointing out that energy had a heck of a bounce here today, and that was being called in question here earlier within the week. You can see that energy had a pretty significant pullback to its rising moving average. It tested it yesterday, and it actually performed pretty admirably there. So I think that's the good news for those of you that are energy bulls. It sold off pretty hard yesterday, closed well off the lows, and still managed to close above its moving average the entire time. And then you get this nice follow-through bounce day here today. So that chart still looks reasonably well. You also find that materials looks pretty strong, trying to break to new highs after today's big 2.2% surge there. You do see that industrials are up here at 3-month highs, and you see that financials are fairly close to 3-month highs. You do have healthcare at 3-month highs. You've got staples very close to 3-month highs. And then you've got these more interest rate sensitive areas, utilities and REITs, that are still lagging on a relative basis there. On the whole, these charts look a heck of a lot better than they did just a month ago, right? A lot of those sectors are closer to multi-month highs, so we have to give credit where credit is due. All right, let's go ahead and do our trade application example now. And this one will be kind of a fun one. Not that I want all of the trade ideas that I do to be quote-unquote fun, but I thought I would have a little bit of fun with things today, given that the World Cup just started here within the last couple of days, and a lot of you are soccer enthusiasts, and some of you, or for those of you in other parts of the world, football, right? Here in the United States, we call the NFL football, and your football is our soccer. So to get that confusion aside, I think most of you understand that. But with World Cup and the beautiful game starting up here with these wonderful nations taking each other on here over in the Middle East, some interesting news broke today. And that interesting news was on Manchester United, one of the big clubs over there in Europe. It is a publicly traded organization. Some of you might not know that. In fact, the Glazers have a significant stake. Those are the folks, the family that owns Tampa Bay Buccaneers and other businesses and things like that. But anyway, Manchester United is a publicly traded soccer club. And if you wanted to become an investor in it, you could buy shares in it. There are a handful of sports teams around the globe where that is a possibility. Most of them are not. Most of them are private, entities, like the Waltons of the Walmart dynasty bought the Denver Broncos here in the United States NFL here over the offseason. So you usually get these ultra wealthy families or individuals to buy sports teams. But every so often you'll come across some that are publicly traded. And Manchester United is publicly traded under ticker symbol MANU. And you can see that this stock just absolutely erupted here today, midday, when news broke that they were considering a strategic sale. Now, just because they're considering it doesn't mean that they're going to follow through on it. So we all have to recognize that as well. This could very well end up being a head fake. Who knows? But what we do know factually is that this thing erupted here midday, and it closed higher by about 14%. It closed just barely under $15 per share. And if that wasn't enough, in the after-hours session, I see that it's trading all the way up here to $16.50 as it's been kind of reported upon on CNBC and other media outlets that might not have caught it initially. That move actually took place right here at about 12:30 my time in the Mountain Time Zone is when that news broke, when all that volume came in right there and the stock just erupted higher. So this traded for about another hour and a half before the market closed with that news, but a lot of people probably didn't hear it unless they follow the markets very closely. A lot of people will hear about it when they read about it in the newspapers or watch CNBC at night or what have you. And so anyway, our trade idea tonight is not on Manchester United, but it is kind of a sympathy play in that regard. What I chose to do is to look at MSGS. Now this is Madison Square Garden Sports. And this is the company behind the New York Knicks in the National Basketball Association, the NBA here in the United States, and also the New York Rangers in the hockey league, the professional hockey league here in the United States. Some people might not be aware that they could be the owners of those two teams, but with MSGS, you actually can. Remember, here on the Thinkorswim platform, if you go to Analyze and then Fundamentals, you can read a little bit more about the company's business summary and different things like that. So you can see that MSGS, Madison Square Garden Sports, is a professional sports company. It owns and operates a portfolio of assets, including teams in sports, including the New York Knickerbockers, or the Knicks for short, of the National Basketball Association, and the Rangers of the National Hockey League, or NHL, amongst other things that they own. But those are two of the premier assets that they own. And so it does make you wonder, well, if there's a lot of hoopla out there with Manchester United right now, possibly putting itself up for sale. And we also hear different things like Ryan Reynolds is speculated to perhaps trying to buy another a professional sports team, perhaps in Hockey League. And we've also heard some rumors that perhaps Jeff Bezos might want to buy the Washington Commanders here in the NFL in the United States. No longer the Redskins, nowadays it's the Commanders. So, there's a little bit more rumors floating around about sports teams out there. And of course, we still have plenty of billionaires on this planet that could help facilitate those types of transactions. And so this one kind of caught my eye for that reason at its base. And then also the fact that it is basing itself from a charting perspective. You can see that MSGS hit a low back here at the end of September and then has been rallying ever since then. And ever since this big candle right here on October 7th, it has stayed pretty much either at or above its rising moving average there along the way. It had a little bit of a slippage here yesterday, but with today's news, this stock was up 3%, not nearly the 15% that Manchester United was. But again, this was not the direct company in the news. This is just a related play. And with that 3% move, you can see we closed at the highs of the day, which means that when I got this trade done earlier in the session, we're already up a little bit on that trade. And again, that's the benefit for those of you that are premium members. You get alerted to the trades that David and I are doing ahead of everybody else. And so this one closing at the high of the day, up over 3%. You can see that we're back to this blue background color on the chart, telling us that we've got this bullish near-term line there, the blue line on the market forecast indicator. And then we also have the green moving average again, suggesting that price is above a rising moving average. Now, the downside of this trade is you can see the S&P 500 is still outperforming it on a 3-month basis, even after today's move. So it's not a perfect trade setup, but nonetheless, it does look like one that's trying to attempt a bounce higher. And as I mentioned to you guys earlier, we got out of our NWN trade earlier today when it touched 49.90, and we had done that trade back here as a bullish trade setup. And as mentioned to you before, we had Zscaler, and we had CrowdStrike, and we had Airbnb, and we had Datadog as bearish trades. So the point is, I've been doing a lot more bearish trades here in the software space, and so I've had a little bit more of a struggle to kind of try to help offset some of those bearish trades I've been doing for you guys in this video with bullish trades, especially when the markets have been behaving themselves like they have been lately. So with NWN being one of those rare bullish trades to the upside that hit our max gain today, it freed up that buying power and that capital that would have otherwise been in it. It made sense to try to find another bullish trade to replace it with. And, I think MSGS is a reasonable candidate for that particular endeavor. Okay, so that's the trade application example for you. Now that wraps it up for tonight's analysis. So if you're satisfied, feel free to shut the video down and move on to whatever else you're going to be doing here either tonight or tomorrow whenever you watch this video. The rest of the video, what I wanted to do is, because we are going to have our Black Friday sale as we do every year here in just a couple of days, we regularly get comments or questions about, well, what is it that you guys actually do at Market Scholars? And it's a normal question. It's a reasonable question, right? David and I are not particularly promotional about what we actually do at Market Scholars. We provide these free videos for you, but you might not always understand, well, what is the difference between these free YouTube videos and what you guys do over on your premium subscription side of the basis. So for the rest of tonight's video, I wanted to kind of walk through some additional comments there. And again, if you're just here for the analysis, feel free to shut down the video. But for those of you that want to learn a little bit more about Market Scholars, from my perspective, then feel free to continue listening on here tonight. And again, we don't do this regularly, as you guys know. We're not the arm twisters. We don't have a marketing team. We don't have an advertising budget. We're just a couple of guys that enjoy teaching and educating folks on the educational market. So we don't spend a lot of time doing this sort of thing. So I appreciate your flexibility here in the rare time that I do it tonight. So let's go over to the internet here real quick and show you the first things first, because we get this question a lot every year when we do this. If you're going to take advantage of our Black Friday sale, and we'll send out the information here later on this week to all of you on our email list, but if you're going to take advantage of that, there is a coupon code that you want to put into that area. And a lot of people cannot find that, or they say it's not there, or I can't really say why they can't see it. It's just perhaps they're overlooking it, or maybe they're not on the right part of our website. I'm not sure. But since I have your ear right now and you can see visually what we're looking at, it's a lot easier for me to describe this in a recorded video format like this than to try to explain it over black and white email. So if you are going to take advantage of our Black Friday sale, what you would do is you would first make sure that you're logged into our website. And remember, you can have a free username on our website. So if you don't have one yet, come up and click the blue subscribe button and get yourself a username and password, right? That's the first thing. That's free. And then once you're logged into our website, you would come over here to the pricing tab and then come down here and click on premium 3-year full access, because that's what we are going to put on sale. We're not going to have a Black Friday sale for the plus month-to-month membership. That's really just more of a trial experience for most people, where they're on it for maybe a month or two, trying to determine whether they'd get value out of the full premium subscription we offer. So our Black Friday sale will only be on the 3-year premium. It will not be on the month-to-month. So if you're trying to take advantage of the Black Friday sale, hover your mouse over pricing, click on premium 3-year full access. Once you're here, you'll see a screen that looks like this, again, assuming that you're logged in. And as you start scrolling lower, there's going to be a couple things that you need to fill out. First of all, you just fill out your name and fill out your first and your last name. That's not too hard for most people, right? That should be abundantly clear right there. You'll also see that our normal rate for 3 years is $29.70. Now, as David has likely mentioned to you, those rates will be going up. We have not raised our rates for many, many years, and inflation has gone straight up here recently, and our costs go up, and our costs to benefit our families. And just like if you're a worker at a company, you're probably getting better paychecks right now. Well, David and I aren't. We're still selling the same thing for the same price, just like we have for the last 4 or 5 years. So we will finally be increasing our prices next year, which is yet another incentive for those of you who are on the fence on joining us. If you want to save yourself even more money, it would make sense to do it now as opposed to waiting until next year to do it. But anyway, if you have a coupon, which is the whole point of the Black Friday sale, is not to pay that full price up there, then where you would go for that is, notice right underneath these gray areas, there's a little kind of widget or hyperlink that says have a coupon. It's right to the left of my mouse right there in orange font. It says have a coupon, question mark. That's what you need to click in order to type in the coupon code. So you would just simply click on it like I've done right there, and then a new field will open automatically. And here I'm just going to type in Black Friday, all one word, with the B and the F capitalized within that one word. And then you're going to have to still click the I agree to the terms of service of the website and all that kind of stuff. You don't have to click this sign me up for the Market Outlook email, because most of you are probably already on that email list. So feel free to uncheck that if you want. But that terms does need to be checked. So now I've got my name, in terms of my first name, my last name, the coupon code for 20% off, and I've checked the terms of service. Now the next thing I want to do is click this blue subscribe for premium access down below. And this will maybe be a little uncomfortable because you're wondering yourself, well, is it taking the 20% off or not? This is not saying you're paying for it. Remember, you haven't even typed in your credit card information yet. This is simply taking you to the next screen. So don't let that scare you or anything. Once I click on it, notice it'll take just a second here. It's kind of thinking about it, making sure that I've, filled out all of this stuff the right way. And then here in a second, there it goes. It will then take you to the next screen. And once you've done that, now you can confirm that that 20% has been officially taken off. So you want to visually see that the $594 is coming off of our normal price of $29.70. And again, that number is going to go up closer to $3,500 for 3 years soon enough. Within a couple of months, it will be going up even further. So this is truly your last chance to get in at our reduced rates here with an additional coupon code on top of that. And that should knock your rate down to $23.76 for a full 3 years. And if you want to think about that, now you do have to pay for it all at once, but if you want to kind of think about it from a month by month basis, like some of you might want to think, well, that number doesn't really mean a lot to me. What does that mean on a per month basis? Because a lot of times you pay for your bills every month, so you have a good feel for what you're paying for. Remember, 3 years is, of course, 36 months. So if you took the $23.76 after that 20% discount and divided it by the 36 months of those 3 years that you'll be a premium member with us, that would be $66 a month. Now, for some of you, you're wondering, well, is that a good deal or a bad deal? And, I don't blame you. I'm a consumer just like all of you. I have to make my own shopping decisions as well. In fact, I was just grumbling to my students here earlier today in class that I get a hotel room in Vegas every year at the exact same time, and I usually buy it this week during Black Friday because I want to save a few bucks as a consumer as well. And one thing that absolutely shocked me is that when I went to go and look at the prices for that hotel room in Vegas last night, the rate was almost 3 times as much as what I paid last year for the exact same room over the exact same weekend. So it wasn't quite 3 times more, but it was more than 2 times more. So again, another example how other businesses out there are most definitely raising their prices to account for inflation. And so I hope you don't hold it against David and I that we will need to do that eventually as well after keeping our rates as flat as they have been over the last 4 or 5 years. It's stinging everybody, but we're all kind of caught up in that, unfortunately. So anyway, again, for those of you that are on the fence of whether you want to join our premium program or not, this is your best chance to do it at a somewhat cheaper rate of $66 per month. And that is very favorable compared to our monthly rate that we charge at a different or a lower tiered subscription. The plus monthly subscription is $99. So again, back over here, if you're doing our 3-year premium, you're only being effectively charged $66 a month. Again, you have to pay that all up front, but if you're just trying to think about it in terms of comparison's sake, this is a lot cheaper and you get a lot more out of this, right? The month-to-month subscription does not get nearly the digital tool access and other classes that the premium membership does. And again, some of you will look at that and say, well, $66, that seems like a lot to me, and that's okay, right? We're all in different places financially. Some of you will say that's the bargain of a lifetime, $66. Others will say, boy, that sounds too expensive. I don't have it in my budget. And we don't ever want you guys to push it with your budget. If you're in your 20s and you're just starting off in life, I would venture to guess that this is probably not your ideal circumstance here. You've got other things to worry about financially as opposed to financial education. If you're getting into your peak earning years, 30s and into the 40s, like David and I find ourselves in right now and above, where you've got a much bigger asset base to start with that you want to personally self-direct, then naturally education and the discipline it provides is going to be worth more to those of you that have more assets. So naturally, if you're just getting started out in life, having graduated from college and you're 22 years old, spending this kind of money on education may not be in your best interest. You're still trying to, make your other ends meet. But for those of you that are in a more stable financial position in your life, then the value of education and what it can provide to you in terms of hopefully helping you make less terrible decisions, right? And I'm not here to say that all of you make terrible decisions, because that's certainly not the case. But I'm sure some of you that are listening to me right now probably made some rather difficult decisions financially in the last year or two, as a whole bunch of people got their wings clipped with all the hoopla around SPACs and cryptocurrencies and all these crazy things that have been taking place here recently. So you have to ask yourself, well, is the education that Brandon and Dave provide, can that help save me money longer term, because I can get more disciplined and more knowledgeable around investing? And we can never guarantee your returns. That's not what we're here to do. We're educators. We're not your financial advisors. But I'm just kind of spitballing with you as to why people choose to become premium members with our organization. And that is one of the key reasons, is we try to help keep them on the straight and narrow. Whether they actually do or not is always entirely up to them, because we don't have control over their accounts or anything like that. But we will give our best effort to make sure that you are doing things that are rational and logical with your money. And if that's been an area of difficulty with you in the past, then it might very well be worth it for you to participate in a premium education program like ours. Now, you'll notice on this screen, by the way, I didn't really finish that conversation up. At this point, after you've recognized what your savings are here, you would just type out your credit card information and then come down below here and click submit, and then you're off and running. But again, each one of you has to decide, is $66 a month a lot or a little? All of you are in different financial positions, and all of you will have a different need from an educational perspective as to whether it would be worth it for you or not. But being the father of an 8-year-old myself, I know there's a lot of things I spend money on for my kid. One good example right now, because we're just in the process of re-upping for him, is Taekwondo. He's been doing a lot of Taekwondo lately. And I'm always a little bit amazed. I grew up in a different generation, in a different part of the world, where sports were usually pretty free for me if I wanted to do them. These days, that is most certainly not the case. For those of you that have kids, you know exactly what I'm talking about. So Taekwondo for my kid is something like $100 to $150 a month. And what he gets out of that is he can attend a Taekwondo practice either once or twice per week for that. So you start questioning, is that worth it as parents, right? As we do with pretty much all of our expenses. And again, every parent's going to come down with a different philosophy there, but I'm using that as a side-by-side example, because for my kid, he can go in and do Taekwondo practice for about a half an hour to an hour once or twice per week. And we are paying upwards of $150 a month to do that. And I just showed you a second ago that in order to access our program, if you're planning on taking advantage of it for the full 3 years, it's $66. So our program is half as much as what I'm paying for Taekwondo. And I'd like to think what you get out of our program is dramatically more than what we are getting out of our Taekwondo. I might not be accurate about that, because everybody gets something different out of it, right? But what we do provide is a lot of content, way beyond what you guys get for free here on YouTube. Remember that David and I each teach 5 premium classes each week. So that is 10 additional premium classes in addition to these 5 free YouTube videos that many of you are familiar with. Now, of those 10 classes, 8 of them are what we would refer to as trading rooms. That will come with their own strategies. They will come with their own portfolios that we are managing that you can follow along with. We very much believe, from an educational perspective, in the application-based education, right? You can go and get much cheaper programs than ours out there, but what you're going to get is going to be probably a course player, right? You sign up and you go through and you do kind of a self-paced course. That's not what we offer at all. What David and I offer is very much application, hands-on education, right? In other words, we are managing 8 different paper money portfolios, making decisions in real time, buying and selling, portfolio management and construction and all that kind of stuff, with 8 different approaches there every single week with 8 different classes. And so you get to see the good and the bad that comes from that, right? Our dividend growth investing class, as I mentioned before, is now making money. We're green on the year as of last week, and continues to be the case today. On the other hand, my top-down trend trading class this year has not done particularly well. It's been a tough year for that strategy. So you get to learn from not only our good successes, but you also get to learn from any mistakes that are taking place and how do we manage through those difficult moments as well. So in addition to those 8 trading rooms, we each also teach a question and answer session for our premium members. And those question and answer sessions are meant to be classroom settings where our premium members can work directly with David and I. So many of you might wonder, well, can I ask you a specific question? And obviously, again, we've got to be careful from a compliance perspective. We can't give you actual direct advice, but we can certainly answer your question in such a way where we can take your general experience, provide our thoughts and our opinions on what is happening with whatever trade setup you're looking at or what have you, and apply kind of a rules-based approach towards answering your question. So it's a way for you, again, to get away from reading a textbook about trading and investing and instead asking a couple of pros like David and I, who've been doing this for more than 20 years each, right? Both of us started investing and trading back during the dot-com bubble. So we've been doing this a while, and this is your opportunity. Instead of buying a book down at Barnes & Noble and trying to learn trading or investing that way, you get to work directly with David and I. Ask us actual questions that you're wondering about and getting our experience there to help you along the way. And we're not going to be perfect either. I don't ever want to come off and suggest that will remotely be the case. Hopefully we make more good decisions than bad decisions, but we'll certainly make our fair share of bad decisions as well, because none of us have a crystal ball. But it will at least be a disciplined approach based upon what our expectations are. And for a lot of people, that is worth its weight in gold. Now, in addition to that, of course, our premium membership here gives you everything that basic and plus memberships have, in addition to all this other stuff you see here in the orange. So that includes our 50 plus customized Thinkorswim chart scripts. So for those of you that use Thinkorswim, we provide shared links that you can import directly into your Thinkorswim platform. So that way you can have the exact charts that David and I use, and that way you can follow along more easily with your education as well. Here's the real-time trade alerts that I had mentioned before. We use Telegram, and we have a private channel on Telegram. If anybody from Market Scholars is approaching you on Telegram in the public, that's not us. So be careful out there. Just like on Twitter, there's imposters and things like that. Our Telegram channel is private, and it is only given to the people who are our premium members from a 3-year perspective. And the benefit there naturally is you get the benefit of seeing what trades we are doing in as close to real time as possible. So as mentioned before, my trade that I did earlier today for this presentation tonight on MSGS, I had sent that out with the trade details on our Telegram channel, just like we do with all of our different portfolios we're managing for our premium trading rooms as well. Now, the nice thing about that is that if you're a busy person that you can't attend our classes live during the day, remember, first of all, they're always recorded. You can actually go back over the years and listen to our class recordings from 3 or 4 years ago if you wanted to. So you don't have to be in the classes live. Some of you are busy professionals and you're at work, and you still might like to do a little bit of trading or what have you on your smartphones. And so by having access to our mobile Telegram alert system, you don't actually have to be in the live classes, and you can still be notified pretty much in real time what trades we did in those live classes. So for a lot of you, that's a big light bulb moment, because many of you knew David and I when we were at TD Ameritrade doing something very similar with investing education. But there, we could not do this. That was a big compliance no-no. We would not be able to send out real-time alerts on the trades that we were doing. So for those of you that used to know us back then and wonder, hey, is there any major difference between what you're doing now and back then? One major difference is that one right there. And again, a lot of people find that incredibly valuable. You also get access to our different class forums and groups on our website, so that way you can ask other students questions about the strategies that we're implementing in class. David does a great job with some of his live projects, Market Outlook Live and other things, kind of reviewing his options trades. I have sample trading plans that you're welcome to download and print off to follow along with the strategies that I'm teaching for my trading rooms. We have lots of tools, including sector selector, stock selector, factor selector, dividend tracker spreadsheet, position size calculator, and lots of other great resources that are available exclusively for our premium members of Market Scholars. You also get access to additional forums like the TOS platform forum, where you can kind of learn from other think scripters and other things like that, and then priority support from a customer service perspective there as well. So lots of great stuff here for those of you that want to commit to your education. And again, each one of you has to make that decision for yourself. We're not arm twisters. Our job to run a profitable company is to make you aware of our business, to present what it is that we offer, hopefully to be good stewards of our educational promise to you, not to twist your arm. So if some of you decide this isn't for you, we will completely understand. It's no sweat off our back. We understand our program is not for everybody. But for those of you that are serious about taking your education from an investing perspective to the next level, we think that we offer amongst the best programs out there at an acceptable rate, particularly right now before we raise our rates next year due to the inflation that we're all experiencing. So that's all I wanted to share with you. Again, if you have questions, feel free to reach out at our email address of support@marketscholars.com, but otherwise be on the lookout for an email heading your way. So that's what I had for you here tonight. Again, if you got benefit out of our analysis here earlier in the video, I would encourage you to click like for me there on Twitter. Also, since I have your ear, I want to thank all of you for your ability to tune in on these videos. Of course, I want to thank all of you premium members as well. But David and I get to do what we love as a profession. And there is very other feeling in the world that is better than that, right? A lot of people just detest going to their job. David and I do not. We love what we do, and we recognize we would not be able to do it without you guys. So in the spirit of Thanksgiving coming up later here this week, I just want to say thank you, a heartfelt thank you to each and every one of you out there that has supported us along the way. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.